For his take on the markets right now, we want to bring in Mike Wilson. He's Chief Investment Officer and Chief U.S. Strategist for Morgan Stanley. And Mike, you're basically saying this is game on. You've got a note out this morning saying you are back to your range for the full year of the pre-Liberation Day numbers you were watching.
That's right. So we came into the year probably a little bit more sort of suspicious about the first half of the year. Prices were quite high. And most importantly, the sequencing of the policy was all going to be somewhat growth negative. And now with hindsight, being 2020, it's pretty clear to see to me that Liberation Day was probably the trough for the negativity of the policy changes. So now, as Secretary of Treasury was just saying, I mean, he's saying basically the markets live in the future, and he's exactly right. That now the markets are saying in 6 months, are things going to be more uncertain or less uncertain? Are they going to be probably more constructive than less constructive? And that's before we even take into account some of the positive things from an administration standpoint that are probably going to flow through. The most important being deregulation.
Yeah,
and then tax, just, really it's resolution of the tax negotiation. I mean, I think if we can just get a bill done, right, an extension of the tax cuts, that's a big relief. Have a path for the funding of the deficits. And now, of course, the Fed potentially comes back into the picture, right? Because if tariffs aren't going to be as onerous, they can now start looking at this dual mandate again and saying, hey, the growth picture, it's maybe a little bit better, but if we're going to err on the side of policy, it's probably to help the growth side than maybe the tariff side, or the inflation side. The tariffs aren't going to be as bad.
Then why are Treasury yields rising today?
Well, I don't think the Treasury market is totally settled on this, because at the end of the day, this comes down to the tax deal too, and the negotiation around the budget reconciliation. There's a lot of supply, and that's what the Treasury market is staring down more than growth and inflation. I think it's all about supply and demand, and there's a lot of uncertainty. We know a lot of supply is coming. How is that going to be funded? Who's going to step up and buy that supply? And can the Fed be helpful in that regard with either rate cuts or some other balance sheet management?
So you're looking for the S&P 500 to be somewhere in the range from 5,500 to 6,100 at the end of the year. You were thinking 5,500 was a resistance level before.
Yeah, we've kind of gone back and forth like everybody, in the sense that our first half target was always 55, 61, with a year-end target of 6,500. We were very much in the camp.
Oh, year-end is 6,500.
Yeah, that was always the case, because we viewed first half tough, second half actually quite good. We did not lower our year-end targets in this, sort of interplay that we've been experiencing, because we felt like it was getting fairly cheap. We never know the timing on that. 6,500 is still our target. We just don't know if it's December 31st or it's the first quarter. It could even come sooner if things really, play faster than what people are anticipating. But yeah, I think our 12-month targets are very much intact. The 55 to 6,100 was always a first half range. And so our view now, I feel better that the second half now, from a rate of change standpoint, can be better than what people are expecting, because the first half was actually worse than what people were expecting.
It's bizarre that would you say we've cured some of the excesses that we came into the year with?
Absolutely.
In this crazy, perverse way. I mean, the Mag 7, some of them are MAGA now, but the Mag 7 were way too overpriced. We had 20% plus years. We had multiples at, what did you calculate multiples at the beginning of the year? 22, 23?
Yeah, on a forward basis, yeah.
So as painful and I mean, a lot of people, obviously, you don't want to go through something like that, especially people close to retirement, and it's unfortunate if they sold, but it was almost cathartic to wring out some of the excesses in the market. You could be more bullish now than you were at the beginning of the year, theoretically.
Yeah, because you cleaned out exposures. The other thing we haven't talked about is, we talked about this earlier in the year, is that there was a fourth sort of negative growth driver for stock market this year, was the CapEx around AI. That peaked at the end of last year, and that deceleration and concern around AI CapEx also really played into the underperformance of stocks in the first half of the year. Now, as we look out 6 months, it's a pretty good case that AI now can become a tailwind again, because now in 2026, there probably will be spending resuming. There will be new applications. The part to really get excited about on AI is the productivity improvements that come after the compute investment. The application layer, something we've written about, right? The adopters of AI. And that's a 26 story. But of course, as you all know, markets live in the future. They're going to start discounting that in the second half of the year.
So you're bullish on corporate earnings now, too?
We're bullish from a rate of change standpoint. So as we've pointed out, the revision breadth reached a very low level around the same time that the tariff, Liberation Day came out, because analysts and companies were starting to guide lower. And if it's not going to be a recession, which I still think the risk of recession is out there, but it's come down meaningfully if these negotiations hold, okay? So if we don't have a recession, then earnings revision breadth from a rate of change standpoint bottomed probably about a week and a half ago. And let's not forget one other big thing. The dollar is significantly weaker now than it was at the end of last year. That's a massive tailwind for S&P earnings growth.
So why do you think the Fed is still in play, that they may actually cut rates?
Well, if let's say the tariff negotiations that went on this weekend become permanent, and we only have a 10% basically reciprocal tariff on the rest of the world, that probably isn't nearly as limiting for the Fed from an inflation standpoint.
But if the economy's doing well, corporate earnings are doing well, why would they step in?
Well, I would argue the economy is still soft. Okay, so I don't anticipate our forecast for the economy going above trendline growth anytime soon.
Okay.
So the Fed is in restrictive zone.
Why not?
That's clear.
Because we've done some damage to it. You talked about deregulation and tax certainty. That should be bullish.
Well, in the near term, right? So we're still working off all the COVID, imbalances that we've had, and as we've pointed out, I mean, a lot of the private economy is in somewhat of a recession. Most of the interest rate sensitive parts of the economy have been very, very soft. The Fed knows this. So why shouldn't why shouldn't we have lower rates to stimulate the interest rate?
No inflation. Bring it on. I know. Put the pedal to the metal.
And also, if you're going to really move from a publicly driven economy to a privately driven economy, something the Treasury Secretary has talked about at length, why not deregulate the financial system, cut interest rates, and really get the animal spirits going? Everything that people were excited about 6 months ago.
Why don't you go to 6,000 to 6,500 then for your new rate?
Well, we are for the second half. Okay, so the second half.
So that's your thing, 6,000 to 6,500.
For the second half. The first half is we're still probably capped below the highs until we get through second quarter earnings
season.
Like
15 days or 45 days left.
That's right. So we're definitely more bullish than our peers. We didn't throw in the towel, in this movement because I think we were prepared for this. We were positioned defensively. And now the only question is, do you really want to go to the kind of pure cyclical parts of the market? The areas that have been beaten up the most, on your previous segment you were showing, the stocks that are rallying the most are what? Transports, consumer goods, right? Semiconductors. Right. The areas that have been beaten up the most. There's going to be a bit of a squeeze here now. The question is, do you really rotate real capital there? The only thing that would hold me back is that it's probably going to take time for the Fed to actually cut rates. And those groups need lower rates for sure to really get things going. Things like home builders and the really sensitive, interest rate sensitive parts of the market.